Stocks are coming off here, but we're going to try and stay focused and look at some earnings for next week. Maybe a couple potential spots of hope with Oracle. Maybe even Adobe can surprise and turn around their AI malaise to some extent. It seemed like the last message we got from Adobe was something along those lines, Jenny, that people are using their AI tools. Just I don't know if it's driving the higher incremental sales when other people are just going to AI to make all their images and design.
Okay, so that was the concern, because I mean, we saw for 2025 they're targeting revenue growth of 8.3 to 9.5%, which right now adjusted earnings expected at about 10.5% at the midpoint. The guidance fell slightly short of expectations, which triggered, some volatility, but amazingly so actually. Adobe's up on the week, which is just shocking to me because
it is kind of amazing.
Like not really for any rhyme or reason, and so I think that is kind of interesting, seeing this momentum into next week's print. I also think it's important to note that we have next week's earnings, but the following week we have the Adobe Summit, so kind of two catalysts in the next 2 weeks. But again, guidance fell short. I do think that when you look at what has worked, what hasn't, you have to be able to give guidance that is as enthusiastic as possible to see positive momentum follow. Maybe I think the best reason right now to be interested in Adobe is its valuation. Shares trade at under 22 times their forward earnings, and historically well below the 5-year average at around 46 times. Also considering it still has an outlook for double-digit growth and has high exposure to AI, it's undervalued, you could make the argument, in the software space. But I read so many of these notes, and I don't think that every analyst understands the entirety of what Adobe does and the difficulty of learning it. I've always made the argument, you completely eliminate your competitive moat with the flood of AI. Right now, Apple has more and more photo offerings that compete with Adobe. Yeah. You also have people that now can basically do what I spent years learning on Photoshop with just like the click of a mouse. So that then, to me, completely eliminates basically the reason that they dominated this photo and video editing software market, because it takes you so long to learn it that once you're in, you're locked in. I'll never use anything but Photoshop or Lightroom. But I think represent a minority, and right now you can do the same things with AI.
Yeah, Premiere too. There's a lot of places, a lot of applications that now are dealing with direct AI competition. You just plug it into a website. All right, so Rick, the potential kind of turnaround here. What do you think? Because Jenny's point, it is pretty strong, kind of hugging the average as the rest of the market's been coming off.
Yes, and we haven't really had much success turning around all the way here, because we did have a severe gap to the downside after our last earnings event that led us down to our 52-week lows. After we broke below this green line here, 434, if you backtrack a little bit, that was the site of our previous 52-week lows. So we had a bit of a dip beyond that level, but we have recovered above it once again. It's now proving to be supportive again here, for the time being at least. This gives us a range to watch, because we also formed a short-term series of ceiling price movements here near about 465. So between roughly 434 to 465 are our shorter-term points to watch. RSI not giving us any clear lean one way or the other as we approach earnings. Pretty common for this momentum indicator to slow down. We are below our orange 63-day exponential moving average, but we are above our yellow 21-day, just barely though. So kind of a mixed signal here as we approach the weekend. If we were to look at our standard deviation channels and volume profile study here, we can see that these low levels are actually pretty important, because it's the site of the volume profile point of control, the area of heaviest trading. So a stock near the lows that's seen very heavy trading and has been beaten up a little bit, a lot of people might interpret that as a sign of potential significant shorter-term bottom, at least, Oliver.
All right, not bad for Adobe. Obviously a bad long-term chart, but in the very short term ahead of these earnings, kind of looks oddly resilient and firm. So maybe they're going to sneak in some kind of better message. Oracle, it does seem like, though, out of these companies, has the most potential to matter to the market, Jenny. I think some folks consider this still a value play.
I think easily this one matters the most to the market, especially because it also has some sizable exposure to the U.S. dollar and the strength of the dollar, which the higher dollar has pressured the company's results as of late. Also was a reason.
So then that should help that things come off big time.
Well, right, which I also think that makes it an even more interesting play into earnings. They've transitioned from their existing base of enterprise customers from the outdated traditional data storage software to this new cost-efficient, higher-valued cloud products, including, of course, AI-driven ones. The company did make one mention on their December fiscal quarter call saying that larger deals they expect to ramp up in the second half of this year, which actually caused some skepticism where some were saying that right now, not only did the guidance fall short on this currency issue, but right now they said that if they would not have basically met the overall expectations if the dollar hadn't have jumped. Second, we do know that they do tend to historically surpass expectations. Higher sales and earnings versus current estimates could at least move the story here to more satisfactory, but I think you have to do more than that this quarter, just based on some of the tones we've gotten from managements of these various tech companies. The reality is, I mean, there's still, I think, a massive sale opportunity for them to grow. Going forward, you have right now definitely tough competition, but they've been able to really carve out a niche for themselves as one of the major AI dominant forces, no doubt. And I also think that, well, CapEx, sure, expected to rise 40% this year.
Wow.
Another name that trades at 22 times its expected earnings for the 3 months coming in around, for 12 months. Software Groups is around 34 times. So it also is, I mean, just at a discount right now. So for both of these names, different stories, and I think that Oracle has, I mean, just looks more impressive from a technical standpoint, but they're both cheap. I mean, I know that that's right now the argument for a lot of tech, but historically cheap even relative to their own valuations.
Yeah, I like that because they've been on this big run, but with the pullback and it seems like some real potential growth and realized growth, it seems like a compelling entry point for stock that's still just hasn't quite gotten the same degree of spotlight as some of the others in the AI trade, Rick.
Could be an entry point here. Could be
it could be breaking.
Yes, it could be a more challenging situation though, because if you were to look here, this earnings event that we had back here in September, it gave us this pretty significant gap to look at. So we've got our gap opening and our gap low point there, post gap up low point at about 143 and 153. So roughly like a 10-point range here. So we can see that we tested those old lows once again a couple of times there. We did again more recently. It happens to also line up with our purple 252-day exponential moving average. However, we broke below them yesterday. We are struggling to retake them today. We've got a pretty serious confluence right at that 153 level. So if we were to keep moving lower, a lot of people probably would have their eye on this 143 level, which gives us a pretty convenient floor and ceiling to keep an eye on here. Notice as well, very heavy volume during our big rally to the upside here that resulted in a false breakout and an eventual decline. So another disappointment for the bulls there. RSI trending downward. We are approaching that 30 mark that would lead us to the oversold area. So keep a look on that point as well for further directional clues. Okay. If we were to look at to the upside and the downside, volume profile point of control is just below the area where our gap began. So around 140 would be a key area to watch to the downside. To the upside, if we were to break back above 153, the heavier volume starts to pick up notably again here near about 169. Also, we've roughly got our 21-day EMA and our orange 63-day EMA, so yellow and orange lines there respectively, pretty much in the same area.
Okay. What was this, Tuesday we got Oracle? All right, well, if the market's going the way it's going right now, we might get down to that big volume note at 140 before the earnings even come out. But if not, then hopefully you get enough good data to find some support at 150. But a big, like, 15-point gap there that this stock is playing with right now, kind of peeking over. It hasn't gone into it yet, but not looking great. Okay, last one, we got Dick's. Didn't they have a pretty good report recently? Because I remember we were looking at the, I guess, persistent buying of some of the, I don't know, sports equipment as it gets warmer or something, maybe?
I do feel like this name, I mean, like a longer
they did have a decent rally.
Yeah, and in this longer term chart, this has been at many points one of our strongest, I mean, more resilient points of retail. I'd say that, like, masterfully, they managed back in 2018, 2019, the supply chain quite well, and have said now more recently in the last couple of months prior to these tariffs being announced, but that they've already diversified more and more of their offerings away from Mexico, Canada, and China. So they are prepared for tariffs. Now, I guess put your money where your mouth is. Will we see that same tone on their earnings call is the good question. But
everybody's using it as a cop-out now.
Well, yeah, and I mean, like, but you have to be able to, I think, to write the narrative in a way where somehow you're like, Gap was able to do so today, and I know different companies, but it's been very much the clear winners and losers of retail. I know it feels like that every quarter, but Dick's Sporting Goods has been at many points a winner. Now we're expecting a year-over-year actually drop in its sales and earnings for the coming quarter. About a 3% drop as far as revenue and a 10% drop as far as earnings are concerned. But
that's not great.
No, it's not. But also, we at least are pricing this in. So last quarter, we did see, I mean, easy to say it was a good report, beat on top and bottom line, raised their full year outlook, but we saw the results were more muted and the pace of growth was slowing, and that was why we saw some pressure. So they gave definitely strong guidance last quarter. Now I think at least that we already have a lowered bar. I mean, for all of these names, you can make the argument historically low valuations just relative to where these names all once traded. We've pulled back pretty substantially from where we peaked. But the good thing about Dick's Sporting Goods is it wasn't 4 years ago. It was, we're off of recent highs, sure, but a name that still long-term looks pretty strong.
Yeah, they always seem to manage to find a way through. Okay, so I know there's something going on. Maybe there's some seasonality too if it starts to warm up a little bit, but I think to Jenny's point, they've just done a good job kind of managing a very complex, difficult place for clothing and apparel retail. Chart-wise, Rick, a lot of chop.
Pretty darn sideways, I would say. That would be my headline for this one. And you can see that we had our high point here, 254.6, and then we had a pretty quick 18% or so decline. Now, we did retreat to, once again, like all of our charts today, an important support area here. We had a series of highs and then a gap up. That was our subsequent low. That was about our recent low, which also happened to once again line up with our purple 252-day exponential moving average. Both of those near like 205, 206 or so. RSI also trending downward. Momentum continues to deteriorate as we have started to steepen our downward sloping trend line here. Notice that we had our upward trend line, a shorter term one. We had a bit of a triangular price shape there as the bulls and bears kind of had it out. And then the decline steepened notably once we did break through that trend line. We've fallen below our two shorter term moving averages as well as we are once again rejected from this short term white trend line today so far. If we were to include our other studies here, we can see our point of control, our area of heavy trading, very close by to current price, providing us with a convenient upside area to consider near about 215. Our two moving averages clustered together right on top of our blue linear regression line, our line of best fit, right around 228 or so, 227, 228. So some upside areas of note, and then the volume, the last heavy node to the downside near about 200.
All right. So it's been breaking down a decent amount, but right in the middle of a range you'd think that would provide some stickiness considering how much we've been there. All that sideways activity has built up a lot of price discovery around 215 that the market seemingly has found to be fair. I like that perspective. Thank you. Rick Ducat and Jenny Horne.